And welcome back for the third and last panel for this conference today. First off, let me also join the others in wishing the Bank of Thailand happy birthday, happy 80th birthday. If compared to the Swedish Riksbank, you're a young adult, I dread to think what the MAS, the Monetary Authority of Singapore, at just 50 years old, we must be like an immature teenager. But we're all on this learning journey of central banking. There's nothing there's no shortage of new things to learn. And 5 years ago, definitely 10 years ago, I don't think we would have had a panel discussion on this topic. So it just shows how much the world around us has been changing, and we need to keep in touch. The introductions have already been made. We're very delighted to have François Villeroy de Galhau, the Governor of the Banque de France, who's with us virtually. He'll lead off our panel with some opening remarks and an interesting set of slides. And then we'll have our distinguished panelists, Shamsiah, Dr. Machun, and Ayhan Kose to respond. And then we'll have a free-flowing discussion, which I hope you can join us in the course of time. Let me, before I turn over to François, just make some very broad context-setting remarks. One is temperature, 2, carbon, 3 is risk, and 4, so what do we central banks and regulators do about it? Temperature, it's always important to remind ourselves that to avoid catastrophic and irreversible climate change, we need to limit global warming to 1.5 degrees Celsius above pre-industrial levels. And that science is becoming more and more substantiated. And those models are being proven more and more correct. We are already at 1.1 degrees Celsius above pre-industrial levels, and the temperatures are still rising. It is quite likely that within the next 10 years, we will cross 1.5 degrees Celsius. And the challenge for the world is then to bring it back down from above 2% back to 1.5 degrees Celsius before 2050. So we are already in quite a dire situation, and it's not surprising, which leads me to my second issue, carbon. To reach this temperature target, we need to achieve net zero carbon emissions, or more accurately, greenhouse gas emissions, which includes methane and other harmful substances, to net zero, meaning the amount of carbon we take out from the atmosphere must equal what we put in. It's a very ambitious target, but that's what the science is telling us needs to be done to cap global warming and avoid catastrophic climate change. So that's another number to bear in mind, net zero by 2050, which means by 2030, which is just 8 years away, we would need to bring down carbon emissions by 45% relative to 2010 levels. 45%. And guess what? Carbon emissions are still rising, which means that's another target we are most likely to miss unless very drastic action is taken. So, according to the UN's emission gaps report, on our current trajectory, assuming that we fulfill all our commitments, the national NDCs and the private sector's commitments, we would still be 55% below the emissions target for 2030. So this is a really serious situation. If I may add, long after the problems of war, pandemic, and inflation are behind us, the climate crisis will still be with us. And I think at the 90th birthday of the Bank of Thailand, when we gather here again, I think we will still be discussing this topic. Risk. So what does this mean? It poses severe physical risk and transition risk. The physical risk is already happening. Yep. You just have to look at Pakistan and look across Asia, Europe, the drought, heat waves, Australia, and North America aridification. It'll affect global GDP significantly. The Network for Greening the Financial System, the NGFS, has done 6 scenarios which try to show the trajectory of how global GDP is going to be affected by the physical change coming from the climate. It'll also have an impact on inflation because food supply is going to be affected, agricultural yields will plummet, and the cost of food may have to go up. Transition risks. To avoid this fate, the world will have to make major adjustments, principally in how it produces energy. And so the shift to clean energy will have its own set of transition risks, which are different from the physical risks. This will, at least in the short to medium term, probably mean higher inflation. And François is going to touch on this phenomenon of greenflation as we make the switch to cleaner energy. It also means not just energy. It means a change in the way all sectors of the economy produce goods. To reach net zero means a structural change in the global economy in every sector on the scale of the Industrial Revolution. It's going to be as big an economic and societal change as the Industrial Revolution. And we know the Industrial Revolution, for all the great things it produced for us, was a very challenging transition. And those transition risks will have to be borne and will have to be managed. So these are important questions for us as central banks, which leads me to the last set of questions, and that's a nice segue into inviting François to come in. So what do central banks and regulators do about it? At the minimum, we need to look at the risks of both transition and physical, what it means for the financial system, what it means for the balance sheets of banks, insurance companies, asset managers, and so on, and how do we prepare and manage those risks. At a minimum, there's already a very important role for central banks and regulators. Then the other question that we may want to ask ourselves, to the extent that the financial sector can help to solve or contribute or enable solutions to the transition, is there an additional role for central banks and regulators to lean in to support and facilitate the financing flows that are necessary? And how can we do that in a way that does not compromise our core mandate, and yet understanding the severity and urgency of the situation, what can we do? Because today, according to various estimates, to take McKinsey, for example, the world needs annually $9.7 trillion US of investment in transition. Every year, 9.7 trillion. Today, we're only doing about $5.8 trillion. So there's a shortage of about 35%. How is the financial system going to level up to provide this additional funding in a way that is responsible, that is safe, and yet contributes to the greening of the economy? And what can central banks and regulators do on that score? So that's just by way of introductory remarks. Now we'll turn over to François, who will share his insights and wisdoms with us on his take on some of these issues. Over to you, François.
Thank you very much, Ravi. I couldn't agree more with your introductory remarks, your alert, and your call for action. I would also like to join you complimenting Banque of Thailand for this 80th birthday. Dear Setaput, it's very impressive. Your bank is older than I am, but younger than my mother, whom I could see yesterday evening, and my mother is in excellent shape, so congratulations. In this lead of speak, I would like briefly to concentrate on what I would call the macroeconomy of climate, and there are scenarios, questions, and these are preliminary thoughts about its consequences on monetary policy. Let me go quickly through some slides. If I can, sorry, I went this way. First, to remind you that thanks to Ravi as chair and to the global secretariat of the NGFS, which is based in the Banque de France in Paris, we published in September 6 macro financial scenarios. I will not enter into details. They are consistent with the IPCC physical scenarios, but perhaps 2 conclusions. First is that the sooner the transition would start, the more orderly it would be. It seems obvious, but it will not be obvious in our democracies. We need time consistency. Transition will be a long journey, and democracy has a short time horizon, so we should really be continuous. And second, that it's very important for central banks to start research and analysis on the macroeconomic part of climate action. We are still a bit late in that field. If I look at the ECB, we are really pioneers in greening our operations, greening our disclosure. We will come back to that. But we are only starting on the macroeconomic analysis. I will go very quickly through this slide about the main results of NGFS simulations. I took here only 3 scenarios: delayed transition in blue, current policies, which is the worst one, in green, and net zero 2050 in dark. You can see that current policies lead to an economic catastrophe by the end of the century, with a possible loss of GDP of about 20%. And if we look at inflation, delayed transition is a quite bumpy road. Net zero would start with greenflation, you mentioned it, but it would stabilize quite quickly. These are only scenarios. These are scenarios because there are many questions, as you can see on this slide, and we try to have very simply 2 axes, one on output and one on inflation, and 4 possible panels. One word, unfortunately, about the top left panel. It's in gray, and it's more or less what we are experiencing with Ukraine. It's a scenario of stagflation, so upwards inflation and downwards growth. It's too early to tell where we will be. I will illustrate in the following slide, but let me probably say that first, inflation is going to be more volatile and less predictable. Second, spelled here, that the phasing and continuity, I repeat it, of climate transition policies will be key. May I perhaps add that the plausibility or probability of each of these 4 panels is not the same, and possibly negative output would be associated with the transition, and possibly also higher inflation, not for sure, but possibly several tenths of percentage points on a yearly basis. Which leads me to some illustrations. We took some scenarios for France. We wrote short terms because this is on the horizontal axis a number of quarters. So 20 quarters equals 5 years. You have each time in red inflation and in blue growth. And each of the 4 scenarios is a traduction of the 4 panels you just saw. I won't comment in detail. Obviously, the picture on the right is much more friendly, so to say, than the picture on the left. Let me perhaps only elaborate on the top left, where we would have a sudden increase of carbon taxation due to a disorderly transition, an increase of carbon taxation by $400 a ton with a very significant effect on inflation. As you can see here, it would be more than 1.5% for a short while. But uncertainty on the bottom left also has a significant economic cost. This brings me to some preliminary thoughts on monetary policy. In the textbook, we should look through if these 3 conditions are met, but probably they are not, especially condition B, and if I can put it with a smile, this is more or less what we thought collectively, central banks, 1 year ago, about the first supply shock of the COVID recovery. And we had to adapt our monetary policy quite quickly. We have other ways of reacting than focusing only on core inflation and looking through. But let me perhaps sum up with 3 simple convictions. First, we have no choice but incorporating climate change in public policies, including in monetary policy. If we ignore climate change, it will be a catastrophe, as you said. Second, the transition might be inflationary and even slightly stagflationary. I stress the might, we don't know yet. But for sure, it's more costly if it's delayed and disorderly. And third, for monetary policy, looking through is or would be a seductive monetary policy strategy, but it's probably a risky one. So we will have to react, but not to overreact. And in this field, more than ever, the monetary fiscal mix is a key condition of success. It's easier said than done, but we'll see. If I come to my conclusion, let me illustrate perhaps the topic of our panel with 2 last brief slides. We like to sum up our possible levers as central banks on climate change with these 2 axes. On the horizontal one, as central bank, we have monetary policy on the right and non-monetary portfolios on the left. And as supervisors, and most of us, I don't come yet to the following, if I may, as supervisors, the vertical axis, we should look at risk, and this is the question of disclosure and stress test, I will illustrate, but also, and you mentioned it, how can we develop opportunities of green finance? And I come to my last slide, which has these 2 parts of monetary policy and supervision of risk. On the horizontal axis, I won't elaborate more, but we have this question of transparency and operations. I insist on the left part, which is models and macroeconomy. I try to illustrate. On the vertical axis, as supervisors, we are making quick progress. You mentioned, Ravi, disclosure, and it will become mandatory, at least in Europe and hopefully worldwide. And I know that many of us are active in that field. The other progress I would like to welcome is the development of stress tests, which is not only the snapshot, but so to say, forward-looking, the video of risk. Let me conclude with that. We were nowhere on climate stress test 4 years ago. Thanks to the NGFS, to its scenario, to many other inputs, we have now more than 35 jurisdictions considering stress test. It's not yet perfect. And we have been running in France the first climate stress test in 2021. But learning by doing is very promising, and I believe we have a toolkit to act, which is now a right answer to your call for action. I will stop there.
Thank you. Thank you, François. It's provided us a very good framework to help us think about the issues. Very wisely, François is not making predictions because we do not know what's in the future, but I think he's presented us a very good framework to think about what might happen and how we go about analyzing this. Made very interesting observations about the upside and downside potential on inflation, and I think this is something that I'd like to hear comments from our subsequent speakers. So maybe with that, I'll turn over to Shamsiah to respond to what François said and to add on.
Right.
Shamsiah, please.
Right. Thank you, Ravi. I also like to take this opportunity to congratulate Bank of Thailand for your 80th anniversary. As the big brother or sister to many of us here, there is tremendous respect and we have learned a lot from you. So congratulations again. So yes, François, I totally agree with a lot of the points that you have touched on in your presentation. And I'm going to echo some of the general challenges that we see in this journey towards a net zero. First, it's we are going to see a further rise, like what you said, in the global prices of key metals and minerals in coming years as the demand for renewables surges and the supply remains tight, especially under a net zero by 2050 scenario. So far, what we have seen is the impact on consumer price inflation from these demand-supply imbalances in these key minerals has been quite limited. But like what you said, François, there is a great deal of uncertainty with respect to the trajectory in terms of demand, supply, prices, and also technology trajectories that would make it very difficult for us to see whether some of these demand imbalances, these price pressures, is going to be persistent or is going to be transitory, and how entrenched it will be, which could, from our mandate, would lead to a much more broad-based price increases. And there is also, like what you said, François, the risk for the monetary policy transmission channels to be impaired should the transition process becomes delayed or disorderly. And the use of carbon pricing, while it may nudge the transition, but it also may add into the inflationary expectation. So there's a lot of communication that needs to be done by the government, especially as how the carbon pricing would pan out and how then it will affect inflationary expectations of the households and the businesses. So the other thing that and another added challenge from an emerging market is that when it comes to the green technologies, the advanced economies would be driving the technology innovation, but the emerging countries would most probably be the manufacturers, of this technology. So this adds greater disparity with respect to the economic complexity. So these are some of the other challenges, François, that as a central bank, in order for us to maintain our credibility, in order for us to be able to manage inflationary challenges, that preserving our credibility in managing the transition and anchoring inflationary expectation is going to be much more challenging in a period where it's very difficult for us to really predict what will happen and what would be the path with respect to demand, supply, and like I said, technology and all the things that comes with it. So I think I will stop there.
Thank you, Shamsiah. We'll now move over to Machin from the People's Bank of China. Machin, please.
Yes, well, let me also start by thanking BIS and the Bank of Thailand for inviting me to join this conversation, and thanks, Ravi, for hosting. Now, I'd like to touch upon this issue from the recent document that G20 Sustainable Finance Working Group has produced, which is called the G20 Transition Finance Framework. I think this framework is very important, as in the past years, many of us in the G20 discussion group have realized that the pure green activities are only part of the object that we need to finance. And a larger amount of economic activities, including those in carbon-intensive sectors, such as steel, cement, non-ferrous metal, transportation, paper, textile, and so on. They are carbon-intensive, but they need to move towards net zero. And in this process, we need to finance their transition. And in fact, I plotted a chart showing that the amount of potential financing that's needed for transition is actually much larger than those pure green activities, which could take the example of renewable energy and electric vehicles. And that's why a framework is needed to enable the financial institutions to identify transition activities, to disclose transition-related information, to develop financial products that's suitable for certain transition activities, and also to incentivize these activities so that we can make them more bankable. That's why this document, which was approved by the G20 Leaders Summit in Bali back about 2 weeks ago, I think is very important, and I encourage all of us to be taking a good look at that and think about how to translate this framework into actual policies and regulations and guidelines from the central bank and supervisors.
Thank you. Thank you, Machun. I think both Machun and Shamsiah have brought up an important point, which is about the importance of transition finance, not just green finance. If you take a rather overly simplistic view of de-risking from high carbon emitting sectors and investing in green, that's not going to get the world to net zero, because only 8% of the global economy is pure green, as in clean energy, solar and wind. The bulk of the economy is right in the middle. You take steel, plastic, cement, and ammonia. Together, they account for 17% of global carbon emissions. We can't do without these things. And yet, they are high carbon emitting. And we need to find ways to finance them in a way that incentivizes them to bring down that carbon content. How you get them to decarbonize. This is transition finance. And in Asia especially, it's a big problem and a challenge. And I want to come back to this, but maybe we'll hear from Ayhan Kose first, and then we'll come back to this issue. Ayhan, please.
Thank you. Thank you, Ravi. Let me also congratulate the Bank of Thailand on this wonderful birthday, and Bank of Thailand and the BIS putting together a very strong program. François' presentation was short, but it was a very rich, loaded presentation. I'm going to make two quick points in response to that presentation. The first one is about the question, should monetary policy look through greenflation shocks, as François put it? He showed us a very simple categorization of climate shocks to think through how monetary policy can react to them. And it's very important that, these shocks, especially the negative supply shocks that basically translate into stagflation, something we need to focus on. Here, the big challenge is that some of these shocks are not necessarily transitory in the context of climate change, but they can be highly persistent. And they can come from different sources, and they can take place at different times. Of course, these shocks can be associated with the energy sector, can stem from labor markets, can be associated with supply disruptions, and can take place in different countries at different times. François alluded it a little bit. This is exactly what happened during the past 2 years. We have experienced a series of supply shocks, and inflation turned out to be more persistent than what we thought 18 months ago. And I think in the context of climate space, this could be a magnified problem for central bankers to deal with. Now, the likelihood of a series of highly persistent negative shocks on the supply side cannot be underestimated when we are discussing, of course, the climate challenge. If that happens, there's a possibility that economic agents will expect higher inflation, not just in the short term, but also in the medium term and the long term. So François basically assumed that actually inflation expectations are anchored in the long term. But when you have a series of supply shocks, there is a possibility that you cannot simply think that these agents are going to consider that this inflation is going to be anchored at the target central bank would like to have. Now, that's a huge challenge, and the implication is that a central bank might have to reassess its monetary policy framework and or its inflation target. Madame Lagarde already alluded to that issue in the morning in the context of the types of challenges we are going through now. And of course, François simplified the problem, and I think his logic is right on target, whether we should think about the core inflation or the headline inflation. But in the context of climate change, when you have persistent supply shocks, the issue is much broader than that, and it requires the type of exercises François showed us, and it requires much more thinking. The second point is these NGFS scenarios, and great thanks to Ravi and François, of course, leading this effort. These scenarios are very comprehensive, very useful, done using a wide range of models and very disciplined. Unfortunately, they are not good if you would like to sleep, because they really clearly show the very serious costs associated with materialization of physical risks. And these risks tend to be much larger than transition risks. One important observation is that GDP losses stemming from the materialization of physical risks is much, much larger for emerging market developing economies than advanced economies. For countries in sub-Saharan Africa, in Latin America, in South Asia, including in some countries actually in this region, in East Asia, these costs are very large. Wherever you are in a tropical zone, the costs associated with the materialization of physical risk very large. The bottom line is that we need to look at the implications for inflation beyond growth and, of course, financial stability, as François did in the context of France, taking these NGFS scenarios and assessing what types of monetary policy challenges these types of shocks will lead to, and get ready given the kind of the picture Ravi described at the beginning of the session. I will talk about these issues as we move along, but let me stop there, Ravi. Thank you.
Thank you, Ayhan. Thank you very much. We've got quite a set of issues. Let's try to unpack them. Maybe start with what's core to our mandate, inflation. I think François gave the correct answer that we cannot know for sure whether it is going to lead to higher inflation or not. But let's probe that a little bit more, and I'm going to invite François to respond to what Ayhan just said, which would suggest that this is in the nature of a series of supply shocks, and it is of a persistent nature over time. If I may give an analogy, the world enjoyed a large, persistent negative price shock with the entry of China into the global economy. It did not happen in 1 year. The entry into the WTO and China's opening up happened over a short span of time. But the effects of that on global production, on global supply chains, global inflation was over 2 decades. And the world enjoyed that windfall. And now, of course, we are looking at that coming to an end. Isn't climate change, the transition issues, of a similar nature? It's not as if the whole world is going to adopt electric vehicles or green energy over 2-3 years. The world is going to do this over 10, 15, 20 years. Of course, the technology cost curves will come down. But at least in the short to medium term, it must mean, and I'm putting this as a provocative question, higher inflation. How would you respond, François?
No, I would fully agree, dear Ravi, with your first sentence. The right answer is we don't know yet, but we must be alert. Perhaps to share 3 thoughts complementing what I said and what you just said, and trying to answer your provocative questions. First, I am quite impressed by the magnitude of estimates we have on this greenflation. And in some scenarios, it could be more than 1% a year, which would be very significant. But most scenarios tell us that the magnitude is probably significantly smaller than that. I would say between 0 and 0.5 on a yearly average. And again, an average is not very significant because, as I showed, it will be very time dependent. But if I had, among many scenarios, to try to give a probability, probably we will have some greenflation, but smaller than quite often mentioned in the past. I would say some 1/10 of percentage point. Not for sure, but this would be my guess or my bet. Second, we should be quite transparent about the macroeconomy of climate. We have, as you are probably aware, this debate in Europe. And there were forecasts by some European institutions quite optimistic about the fact that it would perhaps bring a positive growth shock. It would have no detrimental effects. I don't think it will be very negative, as said earlier, but we should be transparent about the fact that possibly it might have negative economic effects, be it on output or inflation. But the worst economic scenario is if we don't run the transition. This must be for clear. If I take the French example, a renowned economist, Jean Pisani-Ferry, just published some figures about the truth of the transition. I think it's useful in our democracies because the policy case for fighting climate change is obvious. And third, and this will be my last remark, and I found your parallel with the Chinese entry or development in the world economy, and Shamon is going to comment about that. I think it will be a long transition. I agree with that. And here again, the more predictable and consistent in 2 or 3 decades this transition will be, the more welcome its economic effects. There are many debates about the level of carbon price, the kind of tools we should use, etc. But if I had to have a provocative remark on my side, obviously these tools are important. But the predictability and consistency of the tools, whatever they are, is still more important. So we have to coordinate across jurisdictions at international level, and we have to coordinate through the next decades. This is probably the most difficult challenge, but I hope the most promising one.
Thank you. Excellent. As always, a very wise and balanced response. I think it highlights the complexities of the issues. I'm going to ask Shamsiah and Ayhan also to respond to the inflation part. I thought there were 2 points that François made that were important. One is that the estimates so far, there's a wide variance of those impact assessments. And I was just minded that while the MAS's own results are closer to the Banque de France, the Bank of England's estimates, when it did its stress test, was that in an orderly transition, inflation will go up by 0.6 percentage points by 2030, and in a disorderly transition by as much as 2 percentage points. So it shows the variability. But I think it underscores an important point that François made. The longer you delay the transition, the higher the impact on inflation. And that's what I think all our stress tests are showing, that if you delay the transition, the impact on output, negative impact on output, and the impact on inflation is going to be bigger because you are compressing the transition in a shorter span of time. And I think that's what the Bank of England stress test is showing. Shamsiah.
Yep. I think on this, like I said, there's a lot of uncertainties. François, you could keep up underlining, could be, it could be. So there are many paths that, how this, our journey, our respective journey to the net zero would be. And managing the transition is going to be very important. For example, weaning off fossil fuels, it's not going to be easy from where we are, what we need to do, and where we need to go. So, for some, if the transition becomes protected, it will result in, some of the scenarios or the events that you had said. So, communicating on the nature, the impact, and the transmission of this to the economy is very important to anchor inflationary expectation, and more importantly, for us to prevent wage price spirals. So, and that's where I see the big challenges in emerging countries, especially in managing the transition, because not only we have to make sure that inflationary expectations becomes anchored in the face of a lot of these uncertainties, but in emerging countries, there's also the other added challenge of how do we ensure that the transition does not result in what we call financial exclusion, and especially in emerging countries where SMEs, account for in Malaysia, for example, 98% of our enterprises are SMEs. So managing this transition, having this transitional finance, and more importantly, the know-how. So when we talk about the SMEs, yes, they are aware the need to adopt more sustainable practices in order for them to be more viable in the longer term. But what they often struggle with is how do I get there? And that's where so what kind of infrastructure, what kind of measures that a country needs to adopt together with the financial institutions to provide this know-how in a manner that will help the SMEs transition. So for us, we are experimenting with this. We have recently set up a fund, or what we call greening the value chain for the SMEs, where the banks are supposed to help the SMEs measure and reduce their GHG emission. So for me, that's the other added dimension that emerging countries needs to struggle with, because like it or not, we don't have the liberty to chart our own path. We don't have the liberty to be able to chart a just and orderly transition, because on this issue also, we also have to manage the spillover effects from other transitions of other countries. So the challenges faced by emerging countries are much more, because we don't have the headway, and yet we have to do this transition in a much shorter period, and with a lot of the constraints that we have from fiscal coming up from the COVID, and to making sure that like what some of the speakers in the earlier session said, that then how do we drive our economy forward by looking at private investment, looking at supply side policies, and not just demand side policies. And so all this would have an implication as to how inflationary expectation, inflation, and how we conduct monetary policy. Like I said, in all this, it is very important for the central banks to be able to maintain its credibility, because we have seen in the past where the central bank's credibility is impacted, the chances of inflationary expectation being de-anchored is much higher.
Thank you, Shamsiah. Ayhan?
Yes. So let me quickly make three observations. The first observation is what François talked about, this inherent uncertainty when you conduct these types of scenarios, and then of course bring these scenarios into macroeconomic domain, think through the issue of inflation, output consequences of climate-related shocks. Because even in the NGFS scenarios, they are using these multiple models to capture different aspects of transition and physical risks. You look at GDP impacts, for example, the impacts could be anywhere between 3% to 8% to 10%, depending on the scenario you are looking at. François showed it at the beginning of his presentation. By the way, I encourage all of you to get François' presentation and look at it. It's very short, but it has a number of thought-provoking ideas. So the second issue is, given this uncertainty, what can we say about level of inflation and whether it is going to be persistent or transitory? I think if we have learned nothing during the past 2 years, we learned one thing. Even if we think whether it is high or low, transitory or permanent, we would like to be very careful about our observations with respect to future inflation. There's a possibility on the demand side as well as the supply side, climate shocks can translate into higher inflation. And that's something, of course, the type of challenge the central banks have to focus on. And there, I think my third point is how central banks need to adjust their monetary policy frameworks or the conduct of the monetary policy. François' point is, in some cases, the impact is around 1 percentage point higher inflation. So if you are targeting inflation around 2, you might have to consider it's going to be very difficult for you to reach that target not over a short or medium term or the long term. So you might have to adjust your target, or you might have to think about, whether you are going to be much more aggressive when you basically face these types of shocks. And there, I think we need to think about different scenarios. These scenarios can be country specific, but at the same time, we need to think about scenarios for different countries. Those scenarios could have different implications if you are an energy exporter versus if you are an energy importer. So I think the bottom line is that this is an area more work is needed to think through possible outcomes and possible policy responses. It's true, yes, these outcomes are quite wide, but at the same time, it's true that central banks have to be ready to respond to these shocks. One point, Ravi, about your parallel between China's entry into a global trading system and this climate transition. I think China's entry, to some extent, of course, a global shock, disinflationary shock, but the climate change, whether on the upside or the downside, could be a serious global shock that will require serious thinking, how central banks would react to that type of global shock that could be rather persistent. So let me stop there.
Thank you, Ayhan. And listening to the panelists so far, there's also another set of issues that's coming up besides inflation, which is the need for transition finance. And Shamsiah touched on it extensively. I can also say from the NGFS perspective, now that we've got 125 members, the majority are from emerging economies. Much of what I hear from them echoes what Shamsiah just said and what Ayhan also said. And Machun as well earlier on, which is the transition challenges in the emerging economies are just so much sharper. So here I think the question is there a role for us as central banks and regulators to incentivize, to facilitate, to encourage, whatever adjective you use, the financial sector to engage more actively in transition finance? The reason I ask is this. 2 weeks ago, we had our International Advisory Panel meeting in the MAS. We had a very large gathering of global bank CEOs from Europe and America, and of course from Asia as well. And one of the things that the European bank CEOs consistently tell us is that we want to finance Asia's transition because we know the challenges here, but it is extremely difficult because we are under pressure from back home, sometimes from NGOs, sometimes even from policymakers, to exit from coal, to exit from anything that is above a certain carbon footprint. And if we did that, all that's going to happen is that transition is not going to take place. So you need a more intelligent approach to doing this without compromising what I just said at the start, which is the net zero by 2050. You can't compromise that because otherwise the planet is going to be in huge trouble. But we've got to find a way to get there by different approaches. So, François, you mentioned a disclosure and making it mandatory. Some of them have concerns that if they start disclosing in great detail the carbon footprint, looking at current footprints and not looking at transition trajectories, you could have counterproductive results. So that's one question for you. And for Machun, I know China has been doing a lot of thinking on this subject because China faces some of these problems of transition. How do you look at the issues of disclosure and the correct incentives for financial institutions to engage in transition finance? Maybe François first.
Dear Ravi, as usual, your questions are very accurate and acute. Perhaps two remarks. First, on the question of the right transition and the need to finance, at least in the short run, still some fossil energies. I don't think the answer can be to stop disclosure. We live in open societies. So if we have to finance for a while, and in the spirit of a transition, still fossil energies, we should be able to say it, and banks should be able to say it. By the way, you mentioned this challenge for Asia. We have it in Europe in the short run due to the Ukraine crisis. And we are not especially happy that some countries have to go back to coal or oil, at least for some years, in order to substitute Russian gas. We have to define what I call a compatibility path. In the long run, the Ukraine crisis is an excellent incentive to accelerate energy and climate transition. But in the short run, there are some contradictions. So let us discuss about it and be clear about the transition and not to put the dust under the carpet, if you allow me. Second, it's about this question of how can we foster, we central banks, green finance. I am a bit cautious about the idea that we as central banks should finance directly green projects. There is this call sometime, but we are not development banks. We are central banks. Having said that, if I take again the European case, we have to develop the use of private capital and capital markets to green the economy. We have a wonderful project in Europe, and Christine Lagarde, who attends this conference, is a great promoter of this project, is Capital Markets Union. Believe me, Ravi, unfortunately, we were not able yet to convince politicians and public opinion that it's more than a technical and boring project. It's not. If we can mobilize private capitals in Europe, we have, like Asia, significant amounts of savings. It's our collective asset, but we should fund climate transition not only through public investments, because they are limited, but also through private capital and have a green capital market union. I think here we can be strong advocates and we can be very instrumental in promoting CMU.
Thank you. Thank you, François. As usual, you've taken the issue by the horn, not avoided it. I'll turn to Machun now for his views on transition. And I think there's an important point that François made. It's not the role of central banks to be extending financing, but we can play a role to bring together multilateral development banks and the financial sector. So here I'd like to ask if Ayhan can address that. I'm just told Machun has left because he's got some other urgent matter to attend to. So I'm going to pose that question also to Ayhan. Transition finance, what are the perspectives from the World Bank? And how do you think multilateral development banks can work with the financial sector and possibly with central banks to make sure that the private capital that needs to flow into this actually does? Because there's enough private capital, as François says.
Yeah, so thank you, Ravi. François' points are well taken. And I think François would be the first one to say central banks have an important role and a catalytic role to play when we think about combating climate change, when we think about the kind of the finding ways or facilitating the financing, providing a platform for transition plans as well as sustainability disclosures if it is the regulatory entity. But at the same time, we should also acknowledge central banks' role are complementary. The governments have the bigger role when it comes to taking on the climate change and pushing the envelope further. Central banks can do certain things within their own mandates, and they should do so. Now, with respect to multilateral development banks, they have a critical role to play in working with central banks and regulators to help promote basically the collective efforts to deal with climate change. There are different ways how these multilateral development banks can help in terms of analytical work, advisory services, operations, their convening power, last but not the least, lending. So that's quite different than central banks. Multilateral development banks, basically, they put money on the table to push the kind of the climate change related projects. I'm going to talk about the World Bank a little bit. I don't want it to be a kind of a promotional, the kind of the lecture, but what we are doing, I think, is useful to explain how the other MDGs approaching. So we are supporting more than 60 countries to help their financial systems to basically become more agile in terms of supporting the transition to a greener economy. Here, it is very important. These countries, the central banks, the regulatory agencies, have the tools to assess and manage the impact of climate risks in the financial sector, okay? So I would like to make sure we are keeping the boundary very clear. How we are supporting our member countries, emerging developing economies, through several diagnostic tools and the policy tools we have. We have a wide range of tools when it comes to vulnerability analysis of their economies and financial sectors. We have programs in the Philippines, South Africa, Morocco, Vietnam, and we are trying to basically help countries to integrate climate risks into regulatory frameworks and supervisory approaches. We do that in Morocco and Colombia. The climate risks and opportunity assessments are critical. These are, part of financial stability assessment programs, the FSAPs. We do it with the IMF. We did it in the case of Mexico, Bangladesh, South Africa. These assessments provide the type of advice regulators and central banks need on supervisory approaches on climate risks. Now, one important role the IFIs and MDGs can play by contributing to developing and aligning international standards. And there, of course, we are working with the FSP climate roadmap. We are working with the NGFS. And the data issue is a big issue. These entities are, of course, cross-country entities. They play a significant role in terms of collecting this data, making them uniform, and then presenting in a form that's useful. For those of you who do not know, we have a climate change knowledge portal, which is very useful when you think about the historical and future climate vulnerabilities and impacts. And I think the kind of the broader issue with respect to financing, and we are just out of COP27, there was a significant discussion on this issue, and I should briefly mention that. There is a tension between emerging market developing countries on the one side, advanced economies on the other side. There is need to undertake measures on the ground to get ahead of the problems associated with climate change. Some of these problems relate to adaptation. Some of these problems relate to mitigation. Yep. Some of these problems are about physical risks. Some of these problems are related to transitional risks. Yep. But we need to be honest about the essence of the challenge we face, and that is financing. For many emerging market developing economies, climate risks and the consequences of the materialization of these risks much, much larger than for advanced economies. And these economies do not have the capacity, analytical capacity, operational capacity, but most importantly, financial capacity to address these challenges. The World Bank is the #1 multilateral development bank when it comes to climate-related financing. Last year, we basically financed around $31 billion. But Ravi, you mentioned a number, $8 trillion investment needs. So this is just a drop in the bucket. So there is a serious need on the part of global community to address this challenge, and that will start and end with financing. Otherwise, of course, central banks can play certain roles I can discuss in the context of regulation, in the context of pushing, disclosure standards, in the context of providing broader scenarios with the kind of the international organizations as well. But addressing the financing challenge will require huge Herculean effort on the part of global community if we are going to take this challenge head on in the context of emerging market developing economies. But let me stop there.
Sure. Yeah. If I can add, Ayhan, I think you also raised a very important point, because for emerging countries, it's not just access to transitional financing, that access to climate mitigation and climate adaptation financing is equally important. And echoing what Cecilia has said, if I were to get a Christmas wish, is for even middle-income countries, because what we see in the global landscape is there's often help given to the low-income countries or the least developing countries, but countries in the middle-income countries, especially the upper middle income or even the middle income, do not get as much access to IFIs, either financing or know-how. And I think we need to figure out as to how, we also, those that are in this middle income, what we call middle income trap, countries in this middle income also equally have access to the know-how and some of this financing at the concessionary rates, because COVID-19 has impacted all countries, be it the rich, the advanced, the middle-income countries, or the lower, the LICs. But all of us require access to the know-how and also concessionary financing, especially when it comes to climate adaptation and climate mitigation, on top of transitioning financing. So how best, like what you said, so I really am encouraged with what World Bank is looking into, but our wish list is for you to expand the possible beneficiaries to some of your work to the middle income countries also.
Thank you, Shamsiah. That is not only Shamsiah's Christmas wish, it must be all our Christmas wish for many more Christmases to come, that we get transition finance and adaptation and resilience finance in large measure. We've got about 12 minutes left, and I do want to open this up to the audience to pose your questions to any of the panelists, but keep it succinct and brief. Yes, Adrian.
Thank you, Ravi, and congratulations, everyone. And François, you're coming through very clear. Well done. I just wanted to ask, and I suppose to the World Bank, in the sense, what are better ways of leveraging your position, your capital, because you're not going to be able to direct invest or just co-invest with everyone. Is there work going on, first loss recipient, the global balance sheet operating in that place to better leverage, enable private money to come in, and we could dovetail it into François' desire for consistent long-term rules that could be used as indicators for or guidelines for first loss behaviour. Is there any work at all going on?
So, okay, thank you, Adrian. Now, just to provide a little bit of context, because there's obviously an issue here. At the last IMF World Bank meetings, there was a desire on the part of shareholders to look into the World Bank's ability, the first World Bank and then the other multilateral development banks, to be more active in the climate space. One of the kind of the desires of the shareholders was to leverage the World Bank's resources more effectively. Just to address this issue, it's not just low-income countries. Increasingly, middle-income countries need financing to basically cope with climate-related risks. What we are doing now, Adrian, we are preparing multiple papers to have a roadmap which we will soon share with our board, and you will get it through your executive director at the bank. Looking at the operational implications of possible changes, financial implications of possible changes, and of course, how these affect our overall approach when it comes to advisory and policy work we are doing. There is no question, as Ravi mentioned at the beginning, we have to do more when it comes to climate change, given the threat we have. And we feel that, I must say more than other institutions, let me give you just one example, and I think Adrian knows these issues very well. We have give and take 40 small states in the world, the population less than 1.5 million. Some of them are Pacific islands. Some of them are Caribbean islands. These are, most small island states. When you look at the impact of the pandemic, the negative impact, it was felt the most on these small state economies, especially island states. When it comes to climate, the largest impact is felt on these small states. So in the forthcoming Global Economic Prospects report, we assess this damage actually in general. But the bottom line is that these very small countries, and their numbers not small, as I said, give and take around 40, desperately need help to find ways to cope with the consequences of climate change. Okay? And those consequences are simply life-threatening. In some cases, because of the increase in the level of sea, some of the land disappears in these islands. So the leveraging of our financial resources is one way to go. But there, as much as we would like to optimize it, the room we have is small. That's why it is so critical, global community, to provide larger resources directly to these developing economies or through the multilateral development banks. And we are looking forward to having a robust discussion on this issue, but we just need to acknowledge the kind of the big problem here. And that starts with financing and it ends with financing. We can push, as Ravi mentioned, private sector to come to the table. But of course, the private sector has its own priorities. In the context of the bank, we have a wide range of instruments. Some of these are outright financial instruments like green bonds, and some of them we are directly de-risking projects on the ground because we have investment project financing programs. In some cases, our development project financing directly targets climate-related financial instruments as well as projects. So there is quite a work, a large amount of work underway, but the needs, demands from the membership much, much larger. That's why I talked about this need for the global community to be much more active.
Thank you, Ayhan.
May I, Ravi?
Yes, François.
No, add one very simple conviction to Adrian's point. I think we won't miss resources at global level. We won't lack resources. Where we are at risk is the absence of coordination, and it's a distribution problem. And let me briefly explain. We have been observing for 2 decades now the savings glut. We have been observing the diminution of our star. So I don't know whether climate change is the answer to these challenges we have been observing, but at least we had at global level sufficient savings and resources. Yeah. That said, I don't underestimate the distribution and coordination problem we have. It's a very difficult political discussion. I hope COP 27 or 28 now will be useful on that. You remember that COP21 in Paris said very clearly that we had to fund the low-income economies by $100 billion yearly. Yeah. We are not yet there. And there is a very difficult political question. What is a middle-income country exactly? Which middle-income country should receive? Which middle-income countries could contribute? But it's not my job today to settle the issue.
Thank you, François. I'll just scan the room for if there are any. Yes, Cecilia, please. And maybe that will be the last question before we close off the panel.
Thank you. A question for you, Ravi. So you mentioned, I think you mentioned European banks had come to the MAS saying that basically they couldn't help financing climate change in Asia because they were stuck with having to reduce credit exposures in fossil in Europe first. That is what I heard. So
no, not quite. Yeah.
Okay, but because my worry, the way I listened to it, was that are we getting exactly what François pointed, that we need to coordinate and we must avoid a situation where different parts of the financial industry sort of play us out against one another. Yeah. So it would be really interesting to hear more about this interaction and what you said and what you think about these worries.
Yeah. So let me explain. It relates to transition finance. And in Asia, if you look at Asia accounts for 50% of global greenhouse gas emissions. Of that, if you take that on a base of 100, 18% of Asia's greenhouse gas emissions come from coal-fired power plants, right? And Asia is building more coal plants because if you take just Southeast Asia, 45 million people do not have access to electricity. If you take South Asia, it's well over 100 million. And even in countries like India and China, which have been massively increasing renewable energy investments, very impressively, they are still having to build coal plants because of the energy needs of the population. The three things that we all take for granted, electricity, clean drinking water, and modern sanitation, is lacking in many parts of Asia. So, long story short, they are building the coal-fired power plants. We are examining the possibility for early exit from coal-fired power plants, meaning invest in high-emitting sectors and impose a transition plan so that they decarbonize over 5, 10, or 15 years, and they switch to cleaner fossil fuels and ultimately to renewables. Now, in order to do that, you need to stay invested. What many of the global banks are saying is that they see the necessity for doing this because they are in Asia, they understand the situation, but they face pressure from some of their stakeholders and NGOs who want an immediate cessation of investments in coal or other high-emitting sectors. Now, if they were to do that, it will make their balance sheets look good, but you're not solving the world's problem because somebody else is going to finance it, and they're going to finance it in a dirty way. Whereas I think if we got the advanced economy banks to finance them, they can impose good transition plans. So we're trying to build a consensus around it with the Asian Development Bank, GFANZ, and the NGFS to try to build this consensus. So basically what we're saying is we want to provide them air cover. They're asking us, regulators and central banks, can you bless this? Well, we can't bless private sector lending, but we can actually, through our actions and supervision of financial institutions' transition plans, make a pronouncement that this transition plan is going to lead to decarbonization. Yep. It is on a Paris-aligned pathway to net zero. So even if in the short term the emissions profile goes up, it is acceptable. I think they're looking for legitimacy because of the pressures from Europe. So I hope that clarifies. Yeah. Thanks. Yes, Augustine.
Just a very last question. I mean, we have discussed a lot about finance, about information, but the other thing that is really essential is projects. I mean, here in the BIS to support the central banks in their investment in international reserves, we have created these green funds. And one problem we face in Asia is that there is no sufficient emission of bonds that could be investable. And in a way, it echoes the opinion that was expressed by François a few minutes ago, that's not necessarily a problem of resources, but it's more how to use those resources. What can you tell us about projects? I mean, is there sufficient projects? Why are not they coming on board more agile? Why don't we see more about this in a more patent way, so that, you know, this sense of progress is there? I mean, I have a feel, we all, in all these meetings, we feel we're pushing for financing, but at the end of the day, my sense is where is the money going to?
Yep.
So, I mean, I don't know, what can you comment about that?
Okay, I'll attempt that, but maybe Ayhan can also, maybe Ayhan, why don't you go first? Yeah.
Thank you. So let me try to address this point François made. Don't we have the resources? The problem is in the coordination. So the resources, I mean, it depends how you look at it. Here we are telling the international financial institutions to do more. For these institutions to do more, I have here my colleagues from the IMF and from the World Bank. Global community has to provide those resources. And then in the case of World Bank, we can leverage it. So resources can be there, but in many cases, fiscal space is diminished, exhausted. So governments are very careful to allocate and to deliver their promises in the context of COP21 they made to developing countries. Yes, coordination is a problem in the context of climate change, and we should take that very seriously. And this is very similar to this food crisis issue, the kind of the central issue G20 tried to tackle with. Is there a problem about the lack of food at the global level? No. When you look at the stock to, you know, the use ratios, ample amount of grains out there, ample amount of staple products out there, but still we have many countries, especially in Africa, South Asia, having all types of food insecurity challenges. Yeah. You might call it the coordination problem, or you might call it, you know, global communities' unwillingness to provide the necessary support. Now, in the context of projects, Agustin, your point is very well taken. There are projects, not enough number of projects, because when private sector looks at the kind of the climate change problem and the experience they have seen over the past 2 years, there are important lessons. We try to tell, you know, the kind of the polluting sources of energy producers not to invest. And now we are doing exactly the opposite. We are telling them to invest, because we realize that this transition is very difficult. There are significant uncertainties associated with that. That's why in Asia you have a lot of still coal plants coming in line. I think the big issue is somebody has to de-risk the projects and give the private sector the type of, you know, the insurance that there is certain return when they put their money in, you know, climate-friendly sources of energy, because the big issue is energy transition, and then the big issue is transition of commodity markets. So I think we know the problems. We have a good idea how to solve them. Maybe we are not good at coordinating. Maybe we are not willing enough to do the right thing.
Thank you. And I think we've just run out of time. I see 000 in front of me, Board. I will just take a minute or two to shamelessly draw from the wisdom of the panelists who have provided many useful insights. I think first point, The climate change and the transition has huge macroeconomic impacts potentially. We do not know all the details of the direction, but we know it can be significant, both for output and inflation. And as central banks, that is part of our core business, to understand those implications and assess what the implications for monetary policy is. That's one. Second, it has an impact on the financial sector. Those of us who are regulators, we have a responsibility to ensure financial stability and to make sure that the environmental risks associated with climate change and the transition are well managed. And that means stress tests, scenarios, and environmental risk management guidelines and so on. Third, there is a role we can play in disclosure, in requiring financial institutions to disclose not only their carbon footprints, but their sustainability efforts and their transition plans, and how they intend to stay safe and build resilience in their balance sheets. And that will also instill market discipline. And through them, we can probably influence what goes on in the real economy. I think these three things are obvious things that central banks and regulators can do. The fourth is at the edge of our mandate, where we ask ourselves what can we do to lean in or to nudge or facilitate the green financing that is necessary. And here I think the central banks and treasuries of the world have a role in the multilateral development banks. We are major shareholders. And if we put together our plans and our wisdom, we can nudge multilateral development banks to maximize the use of private capital. I fully agree with François. There is no lack of money to solve this problem. But unfortunately, the money is sitting in three different places which are uncoordinated. One part of the money is sitting in multilateral development banks, which we need to maximize to draw in private capital. Today, the ratio is 1 to 1. $1 of MDB money draws in $1 of private capital. We need to raise that 5 times or 10 times. That means major reform. And that means the shareholders, that means treasuries, central banks, and governments. The other pocket is banks. Now, banks are willing to lend, but they have to watch their risks. And I think for good reason. And many of the projects, Augustine, in this part of the world are below bankability. This is where public capital needs to come in to tip them over so that the banks can lend with a decent return and minimize loss. And then the third pocket is institutional funds, capital markets, and they are huge. But they're not going to be investing in a solar plant or any of those lumpy projects. These investments from the bank's balance sheets, and I would also say from the multilateral development banks, need to be taken off, securitized, and sold to private institutional investors, because that's where most of the money is. That's the largest bucket. If we can get this coordination, we look to the efforts of people like François, Christine, and others to move this, I think we can solve this problem. And it's a problem that can be solved to avoid what we call the tragedy of the commons, because we all think it's somebody else's problem, it's not my job. But none of us have the instruments to solve this on our own. But if we pool ourselves together, it can be solved. So maybe with that, I'll end off this session. Thank you very much for your attention. Thank you.